Hello, friends. Today we're taking a look at Pfizer, ticker symbol PFE. This company has been beat up in the last year, getting close to their 52-week lows, and we're going to be looking at to see if this is a company or stock that should be considering to adding into your portfolio. Analysts believe that the target price for Pfizer is somewhere around $40 to $42, which will give you a nice 40% to 50% up. In the last month, it has been down almost 6%. Year to date, it's down 43%. And in the last 5 years, it's down almost 35%. They pay a dividend of $1.64, which is, as today's prices will be, a dividend of close to 6% at 5.7. They reported earnings not too long ago, and we're going to be taking a look at their earnings right now. They reported on October 31st. They beat in normalized earnings, but they reported a loss for the quarter. And this is part of the problem that Pfizer has been having, is that it has been reporting some losses. Also, it has been reporting, they reported a revenue miss, which is a little bit understood because of the amazing amount of revenue that they got from their COVID vaccines. What is also concerning for a lot of investors is that most analysts are looking at the next earnings. They're looking also for another loss of somewhere around getting a little bit better, but still a loss. EPS revisions for the past 90 days is being 15 revisions down and 0 up. Part of the problem, if you look at the presentation, is the revenues are down year over year of somewhere around 41%, but the expenses are up 44%. That is creating a lot of strength on this company. For those that don't know, I'm assuming that you know that Pfizer is a drug company, so they manufacture a lot of different drugs. They have a lot of different drugs in which they get their money, and part of the problem that also they have been having is they have been sued lately. They have had a lot of lawsuits. There is a political pressure on, especially on the Republican side, and I don't want to talk about politics, but of possibly allowing people to sue companies or sue the government because of the vaccine mandate. So that's a whole mess that legally we don't know where it's going to go. That is creating a little bit of pressure, but mostly the problem, I don't think it has to do with that. It has to do with these costs and revenues. One of the things that I will say is I personally don't own Pfizer, and I don't plan to own Pfizer just because I try not to invest on companies that I do not understand. And for me, drug companies in general, they have a lot of moving parts. They have a lot of different types of. It's just very sophisticated kind of business, and I would like to understand it much better. But with that said, I just also want to remind you that I am just a YouTuber. I am not a professional advisor, and everything that I say here should not be taken as financial advice. This is just my opinion, and I would love to hear your opinions on why you are either staying away from this stock or why you are planning to invest, or why are you invested on them. Let's jump directly to the financials. So as you can see, their revenues before COVID, they were very steady. And as you can see, there was a huge jump. So the growth, even though it says that it's 5% in the last 10 years and 12% in the last 5 years. I will say that their growth has been flat. I will be trying to look at pre-COVID numbers later when I'm doing evaluations. Earnings, they're very cyclical, as you can see, but before COVID, they kind of stay between the range of $1 to $3.50. But even as of today, it has stayed a little flat. They did had a spike on 2021 and 2022 because of the things that we talked about. And in the last 5 years, their per offer margin has been of 27%. When it comes to free cash flow, they were steady before COVID and at somewhere around $2 to $2.50. And in those 2 years of 2021 and 2022, as you can see, there was a huge free cash flow inflow. So I will be thinking that it's going to remain flat. Coming up. Book value, once again, before COVID, stay flat between $10 to $12, but it came up in the last 2 years. Return of invested equity in the last 5 years average is 26%, which is higher of the 15% that I always look for. Return on assets, it's almost 10%. This is the average of the last 5 years. I always look for at least 5%. And return on invested capital is under the 15% that I look for at 6.5%. The growth in the last 4 years of the book value is 4%, and in the last 5 years, almost 10%. Dividend, they have had a nice gradual growth. In the last 10 years, it has grown 5%. In the last 5 years, it has grown almost 4%. And their payout ratio, it's very high. I'm going to start adding this number, this metric, since some of you guys have been asking for it. And I will be feeling more comfortable with a payout ratio if I was investing because of the dividend, close to 50%. When it comes to long-term liabilities, the long-term debt has grown. They stayed steady, except on this year, it has grown a lot. So I wouldn't be looking too much at these two numbers growth, because it makes no sense. It's an outlier. You could say that it's been maintaining. It hasn't been growing too much, and the long-term debt has been. It will be if they were to maintain the average of the last 5 years on free cash flow, it will take them close to 3.5 to 4 years to pay it off. Now, if we go back to it, that is because of these two big numbers. So honestly, if they were to take the average of, let's say, $2.25, it will probably take them somewhere around less than 5 years, with this $10 per share. When it comes to shares, it has been going steady down. In the last 10 years, they have bought back close to 2% of their shares, and in the last 5 years, 1.13%. I believe that most of the cash flows that they have been getting is they have been having a lot of acquisitions, and that's something that big pharma tends to do. They tend to buy smaller companies. It's just more efficient for most of them than having to start from scratch and trying to develop a drug. So numbers are a little bit everywhere in the last 5 years. So I am going to be analysts think that their growth is going to continue to decline in the next 5 years. So I am going to be using more of a flat number of 2%. When we look at multiple historical numbers, If we take the last 5 years average, multiply by the 10-year medium, we have a price somewhere between 41, a fair price of somewhere between $41 to $45. But something that I've done is I have gone back and take the average of the what I call normalized revenue, earnings, free cash flows, and book value, which is pretty much taking everything from 2013 to 2020 and ignoring 2021 and 2022. And if we were to do that, a more normalized fair price will be $34. In a payback time, I have done the same thing, growing the free cash flow at 2%. It will give us somewhere between $27 to $55, but whenever we use the normalized number of 227, growing it at 2%, we'll get somewhere close to $42. Looking at earnings, we grow it at 2%. We multiply it by a PE of 18, which is the medium somewhere around in the last 10 years. And we discount it back. The price will be somewhere between $18 and $28. But if we use a more normalized EPS of $2, it should be somewhere around $20.66. We do the same thing with earnings valuations, and we have a more normalized fair price number of $52. And if we take all of the numbers together, and I know this is a lot of numbers, sorry for that, but I know that you guys, some of you love this, we can see why a lot of the analysts are looking at a $42 price, a fair price, because it's somewhere around the average between the numbers that I have here. However, if we were to take more of a normalized view, we're looking at a $36 kind of fair price, which still, if you will want to jump in now, that is about a 25% margin of safety, and it will put you close to the number that we have it right now. I guess at 23%. No, 20. Yeah, 25. So that is the information that I have. I will encourage you to do your own research. Do not make decisions on that. So I personally will not be investing on this, but to answer the question, is it time for you to look more into it? If you like this kind of company, you understand it, I will encourage you to keep looking at, because it's nice 25% down. I will also encourage you to hit the like button, subscribe, and I see you in the next video. Bye.